The European Union and the United States are nearing an agreement to impose a 15% tariff on most European products, aiming to resolve ongoing trade tensions. This potential deal, which includes sectors such as automobiles, is a significant development in transatlantic trade relations. The negotiations are reportedly progressing well, but any final agreement will require approval from U.S. President Donald Trump, whose decision-making remains unpredictable. The EU is prepared to implement countermeasures, including a 30% tariff on €100 billion of U.S. goods, should an agreement not be reached by August 1st. These countermeasures would affect U.S. exports like Boeing aircraft, U.S.-made cars, and bourbon whiskey. The U.S. has recently struck tariff deals with the Philippines and Japan, reducing duties on imports, which has sparked optimism among European automakers that similar reductions could apply to their products. U.S. Treasury Secretary Scott Bessent has downplayed the EU's tariff threats as negotiating tactics, while acknowledging progress in discussions. Meanwhile, the EU is considering using the Anti-Coercion Instrument, ACI, as a deterrent, which would allow for retaliatory actions if necessary. However, most EU member states prefer to focus on negotiations with the U.S., hoping to avoid escalating trade tensions further. European automakers have responded positively, with stock rallies following the U.S.-Japan trade deal, reflecting hopes for reduced tariffs on their vehicles.
S&P 500 futures remained relatively stable following the release of earnings reports from Alphabet and Tesla. Alphabet's shares rose by 2% after the company exceeded expectations in its second quarter earnings and revenue, signaling robust performance in the tech sector. Conversely, Tesla experienced a 4% decline in volatile trading due to a consecutive drop in auto revenue, highlighting potential challenges in its core business operations. IBM also faced a setback, with its shares dropping 5% after disappointing software revenue results, which weighed on Dow futures. These mixed earnings results underscore the varied performance across tech and auto sectors, influencing market dynamics. The U.S. stock market has been buoyed by optimistic developments in international trade negotiations. President Donald Trump announced a significant trade agreement with Japan, which includes reciprocal tariffs, and progress towards a trade deal with the European Union has been reported. These developments have bolstered investor sentiment, contributing to the S&P 500's 12th record close of the year and pushing the Dow Jones Industrial Average close to a new record. The positive trade news has provided a tailwind for equities, sustaining the market's upward momentum amid the ongoing earnings season. As traders anticipate further earnings reports from major companies like Honeywell and American Airlines, along with key economic data, these factors will continue to shape market sentiment and investor strategies.
Shay Capital has issued a letter to the board of Beyond Inc., urging the company to expedite the monetization of its Medici Ventures portfolio, which includes significant stakes in blockchain entities T0 and GrainChain. Despite Beyond's successful revitalization of its core operations with Bed Bath & Beyond and Overstock, Shay Capital, a major shareholder, expresses concern over the underutilization of these blockchain investments, which have absorbed over $400 million from shareholders. The call to action includes creating a special purpose vehicle, SPV, for GrainChain and issuing shares as a dividend to provide transparency and potential value appreciation, alongside a contingent value right, CVR, tied to the broader Medici Ventures portfolio. The letter emphasizes the need for swift execution, suggesting that a successful IPO or SPAC merger for T0 could significantly enhance Beyond's capital base, supporting further strategic acquisitions. Shay Capital highlights the urgency of these actions, given the substantial investments and the potential market positioning of T0 compared to other blockchain firms. The letter concludes with a demand for a detailed response from Beyond's board within 10 business days, underscoring the urgency and importance of these strategic moves for maximizing shareholder value.
The FTSE 100 index has reached a historic milestone, closing at 9,000 points for the first time, driven by a surge in large-cap mining stocks. This rally is attributed to market reactions to proposed tariffs on copper imports by President Donald Trump, set to commence on August 1st. As a result, copper futures have soared, significantly boosting mining shares, which constitute a substantial portion of the FTSE 100. Notably, The UK index has outperformed the S&P 500 by 13 percentage points since January, showcasing its resilience amidst global market volatility. The FTSE 100's composition of necessity-driven businesses, such as energy and food, provides stability and supports its performance during economic uncertainty. The index's recent success also highlights the role of currency fluctuations in its valuation. A weaker sterling often enhances the FTSE 100's performance by increasing the value of foreign earnings when converted to pounds. Despite its achievements, the FTSE 100 remains undervalued compared to other global indices, with a price-earnings ratio of 13.6, making it relatively attractive to investors. This milestone underscores the potential of diversified, stable investments to deliver returns even amid global economic challenges, reinforcing the FTSE 100's position as a robust investment option for UK pension savers and investors.
Kohl's Corporation is grappling with significant financial challenges, as outlined in a recent analysis by Giacomo Boccanegra. The retailer is experiencing declining sales, excess inventory, and unprofitable store operations, suggesting a structural decline rather than a temporary setback. A key concern is the diminishing returns from its Sephora partnership, exacerbated by Amazon's aggressive pricing strategies, which erode Kohl's competitive edge. Moreover, the company faces financial strain, having refinanced its debt at a steep 10% interest rate, underscoring its deteriorating balance sheet and elevated leverage risk. The analysis suggests that despite potential short squeeze scenarios, the fundamentals of Kohl's remain weak, leading to an unjustifiably high stock valuation. The recommendation maintains a sell rating on Kohl's stock, NYSE KSS, reflecting skepticism about the company's ability to navigate its current challenges effectively. This situation resonates with the struggles faced by JCPenney, another retailer that battled similar issues. The broader implication for investors is the necessity to critically assess the sustainability of Kohl's business model and its strategic initiatives in the face of mounting competitive and financial pressures.
Heathrow Airport is contemplating legal action against National Grid plc following a disruptive fire on March 21 that halted operations at the airport for 24 hours. This incident led to the cancellation of over 1,300 flights and significant delays, affecting both passenger travel and air freight. A report by the National Energy Systems Operator, NESO, identified a known fault at an electrical substation owned by National Grid as the cause of the fire. The report highlighted that National Grid had been aware of the issue since 2018 but deferred necessary maintenance. This oversight resulted in a power outage impacting Heathrow's critical systems, underscoring vulnerabilities in the UK's infrastructure resilience. The financial repercussions of the airport's shutdown were substantial, with airlines reporting losses between £80 million and £100 million. Heathrow, a crucial hub for UK air cargo, handled 1.58 million tons of cargo worth £215.6 billion in 2024, emphasizing the broader economic impact of such disruptions. In response to the NESO report, UK energy regulator Ofgem has initiated an investigation into National Grid's compliance with its license conditions. Additionally, the securities litigation firm Levi and Kursinska has begun probing potential violations of federal securities laws by National Grid, whose shares are traded on the New York Stock Exchange. This incident raises critical questions about the adequacy of infrastructure management and the robustness of contingency planning for key national assets.
The silver tsunami, a demographic shift where baby boomers are retiring and selling their businesses, is creating significant opportunities for entrepreneurs and investors. According to the U.S. Census Bureau, over half of U.S. employer businesses are owned by individuals aged 55 or older, many of whom are preparing to exit. These businesses are typically well-established, profitable, and come with loyal customer bases and experienced staff, making them attractive to potential new owners. However, the key differentiator in the current market is the level of technology adoption within these businesses. One sector particularly poised for growth amidst these transitions is the independent used car dealership and repair industry. Despite economic fluctuations, this sector continues to thrive, with U.S. used vehicle sales surpassing $150 billion in 2024, as reported by IBISWorld. The success of these businesses hinges on embracing modern technology, such as AI-based systems and cloud platforms, which enhance operational efficiency and customer engagement. Entrepreneurs and investors looking to capitalize on these opportunities should prioritize businesses that have integrated digital transformation into their operations, as this is crucial for maintaining competitiveness and driving growth in today's market.
Ethereum's price has surged by 160% since April 2025, driven by a significant supply-demand imbalance, according to Matt Hogan, Chief Investment Officer of Bitwise Asset Management. The crypto asset saw more than $5 billion in net inflows into spot Ether exchange-traded products ETPs from May 15th to July 20th, illustrating heightened investor interest. This influx, coupled with corporate acquisitions, has absorbed approximately 2.83 million ETH over 9 weeks, while the Ethereum network issued only 88,000 ETH, resulting in a 32-to-1 demand-to-supply ratio. Companies such as BitMine, SharpLink, and Bit Digital have notably increased their Ether holdings, with Bit Digital reallocating capital from Bitcoin to purchase 100,000 ETH. The trend of Ethereum being adopted as a treasury asset among crypto-focused companies is gaining momentum, with projected acquisitions potentially reaching $20 billion, or around 5.33 million coins, by year-end. This is set against a backdrop of Ethereum minting only 800,000 ETH, indicating a 7-to-1 demand-supply imbalance. Despite Ether's lower representation in ETPs compared to Bitcoin, with Ether funds holding less than 12% of Bitcoin-oriented ETP assets, its role as a preferred platform for stablecoins and tokenized assets positions it for continued inflows. As of the report, Ethereum is trading at $3,703, with expectations of sustained demand barring any major regulatory shifts.
The current financial landscape is marked by a robust rally in U.S. stock markets, despite ongoing geopolitical tensions and economic uncertainties, including tariffs and Federal Reserve policy disputes. The 4 major U.S. stock indices, Dow, S&P, NASDAQ, and Russell 2000, are experiencing renewed highs after initial setbacks from President Trump's tariff announcements. Investors are optimistic, buoyed by potential trade deals with Japan, the European Union, and South Korea, which could avert substantial reciprocal tariffs. This optimism persists even as analysts caution about the potential impact of tariffs on corporate profitability, with Goldman Sachs estimating a baseline tariff rate of 15% that could strain company valuations. Compounding the market dynamics is the tension between President Trump and Federal Reserve Chair Jerome Powell. Trump's criticism of Powell's interest rate policies and the potential appointment of a successor before Powell's term ends in May next year have introduced further uncertainty. The market's reaction to Trump's threats to dismiss Powell has been mixed, with a brief downturn in equities and the U.S. dollar, while precious metals rallied. However, the anticipation of possible aggressive rate cuts is seen as a double-edged sword, potentially boosting stock prices but risking inflation and undermining the U.S. Treasury market. As Trump navigates these economic and political pressures, the markets remain cautiously optimistic but wary of the broader implications for economic stability and central bank independence.
American Airlines Group, ALL, is set to announce its quarterly earnings on July 24, 2025, with analysts projecting an earnings per share (EPS) of 77 cents. Investors are eagerly awaiting the announcement, not just for the earnings figures, but also for the company's forward guidance, which often plays a significant role in influencing market reactions. In the previous quarter, American Airlines exceeded EPS expectations by 8 cents, resulting in a 1.46% uptick in its share price the following day, highlighting the market's sensitivity to earnings surprises and guidance. Currently, American Airlines shares are trading at $12.50, representing a 19.76% increase over the past year, indicating a generally bullish sentiment among long-term investors. The upcoming earnings release is particularly significant as it may impact the stock's trajectory, depending on whether the company meets or surpasses market expectations and provides optimistic guidance for future quarters. As earnings season progresses, stakeholders will be closely monitoring the results and guidance for insights into the company's operational performance and strategic direction.